but I want to talk about specifically in the Bitcoin and in the cryptocurrency markets specifically today, because that is where we have some serious drama going on. Now, I talked about, I think it was a couple of weeks ago, breaking down what happened with Terra Luna, the U.S. stablecoins, UST, and how it was backed with another token called Terra Luna token, and how they tried to have this algorithmically pegged so it always stay at $1, and how it failed. And I broke all that down. If you want to go catch up on it, like I said, go to the podcast network and listen to that. But what's happened is it's created contagion. What does that mean? Well, you understand like being contagious, right? If you get sick, being next to someone else who's sick. Of course, you know all about that. We've gone through 2 years of a pandemic. Of course, you know about contagion. And so we also see that inside the financial markets. Now, the first time that I really saw this for the first time, where I really, really remember, was in 2008. And we saw the great financial crash, or the global financial crash, however you want to call it. I'm not sure which one is right. The GFC, they call it. And what we saw is the global financial markets all melted down because they were because of contagion. They were all contagious next to each other because they all had exposure next to each other. And so this bank had debt with this bank, and that bank had debt with that bank, and that bank had debt with that bank. And so when one went down, it was like a domino effect. And that's sort of what we're seeing today. And we knew that it was going to come because after 2008, supposedly the bankers and the regulators that are going to save us from the problems they create for us went and passed a bunch of new regulations to prevent something like this from happening again, which sounds like a good idea, which is exactly what they should do. Now, I grew up, my dad always told me over and over and over, hey, look, once is an accident, twice is stupid, right? You've heard like, fool me once, shame on me, fool me twice, or no, fool me once, shame on you, fool me twice, shame on me, right? So it's like, hey, look, mistakes are made. But the best we can do is learn from those mistakes so we don't make those same mistakes again. However, supposedly after 2008, they went to pass a bunch of new regulations to prevent that from happening again. But as a matter of fact, all it did was make things worse. And so now we have even more centralization through the banking system, through the financial system. And so we always knew that the next one was going to be even worse than the last one. And we're seeing it throughout the financial system, throughout Wall Street, but also through the cryptocurrency markets, which bring me back to the point that I'm making. And so back to a couple of weeks ago, we're here talking about US Terra Luna, the token, the stablecoin, and how when it crashed, it took out $60 billion. That's B with a B, a billion with a B, $60 billion worth of liquidity out of the markets. Now, it was devastating. I don't know how many people, hundreds of thousands of people, potentially millions of people lost a lot, potentially lost it all. I was in Vegas last weekend at the biggest crypto conference in the world at Consensus, and I was at their official after party, whatever. I was at some party, and someone walked up to me and he's like, "Hey, Mark, I'm a big fan. I've been following your stuff for a long time." And he said, I booked this trip to Consensus a while ago, and I bought the Whale Pass, which was like the biggest pass you can get for all the networking events and stuff like that, because I was coming here to network and I was going to launch these new things. But it's all over now. I can't do that. I'm like, well, what happened? What do you mean? He's like, well, I'm 50 years old and I've had this marketing business for the last few decades. And, don't worry if you're listening, I'm not going to call you out, but if I'm talking about you. But he said, I've been running this business for the last couple of decades, and we did really good, this marketing business. And I sold it. I sold the company. I had a big event. I got a lot of money, and I was kind of done. Like that area of life was done, and I was kind of like looking to the next thing. And I took all that money and I parked it into this stable coin because I thought it was stable. I thought it was like $1. And I didn't really pay attention to it because I thought it was safe. And I lost it all. Lost all his money. Now, there's thousands or hundreds of thousands of stories like that. I heard there was 14 or 15 suicides in the first week after that. But I don't want to dig back into that story again. The point is that lots of other cryptocurrency projects and even traditional Wall Street hedge funds were invested into that project, which means they have big losses. And then when they have big losses, that means someone else have big losses, and the dominoes are falling. Now, I warned about this 2 weeks ago, and I said that first, any stable coin that's not 100% backed with dollars or dollar equivalents is a problem. I think there's three: USDC, GUSD, and Paxos. I said that's a big problem. And then I said that I also think that they'll start going after bigger and bigger ones, like Tether, for example, is probably going to be a big target. But it looks like the next one right now has been Celsius. So Celsius is a platform that allows you to earn yield on your Bitcoin and cryptocurrencies. So I could give them my Bitcoin, and they, in exchange for me giving it to them, they would pay me back 4%, 5%, 8%. I'm not exactly sure what their yield was towards the end here. What comes next? So Celsius had massive exposure to Luna. Who else had a massive exposure to Luna? And who has exposure to Celsius? Like I said, right off the bat, Celsius is causing the whole market to draw down because they're liquidating as much as they can, trying to post more collateral. And this is what happens in a liquidation event, no different than the stock market. When the stock market crashes, it continues to crash even faster because people are trying to cover their margins and then leverage on their stocks. This is why stocks fall really fast. And then you'll also see, when the stock market crashes, like say 2008, the stock market crashed, the S&P 500 dropped about 60%, and gold dropped 25%. Now, why would gold drop? Shouldn't gold be going up during that time? And the reason why is because of a liquidity event. When they start crashing, everybody's selling anything they can to get money to cover that leveraged position, which is exactly what happened back in the stock market, and that's exactly what's happening now. So it brings the whole thing down. So whether you only hold Bitcoin and it's in your cold storage, or whether you're playing with all these things, we're all being affected by this, which I'm not super happy on. Now, somebody might just say, well, shoot, shouldn't we pass some laws that prohibit this from happening? Shouldn't we pass a law that says, these Wall Street raiders aren't allowed to short the heck out of these things? Shouldn't we pass a law that prevents, whatever? And my answer is no. My answer is no. Now, I'm affected just like a lot of other people, but I would still say no. And the reason why is I believe in free markets. And if somebody wants to post a risky trade, then somebody has to take the other side of it. That's how a trade works. A trade doesn't happen unless there's two willing people involved. Otherwise, there's no trade. And so in a free market, both people believe they're getting the better end of the deal. Otherwise, there would be no deal. And so somebody's willing to take that risk for the potential reward, and this person's willing to pay a potential reward for that person taking the risk. Now, other people get involved and they start betting on those two players, and then they're taking risk, and everybody's taking risk. And in a free market, that's just what happens. It's up to everybody to be educated on their own. The bigger problem, though, is we're in an environment that allows this to happen in the first place, not because it's allowed legally or from a regulatory standpoint, because of the fake fiat monetary system that just pumped $8 trillion into the ecosystem over the last 24 months, and basically in something called the Cantillon effect. Go ahead and Google that if you want. And it says that the people that are closest to the money supply have the first advantage because they get the money first for the cheapest price, and then they start pushing it up as it goes down. So the hedge funds, the banks, they get the money first for basically free. You and I, we don't get any money, and we certainly don't get it for free if we do get it. And so they're getting billions of dollars for basically free, and then they're using that to manipulate markets, like, for example, buying up all the single-family homes in the United States. Now, they're paying 30% over asking price. You and I can't do that because we have to pay, well, now interest rates are 6%, but they got the money for free. So they can afford to pay more for the house because they're not paying for the money. And they're also using that money to take out these crypto positions and so forth. And so the problem is that we need to take away the money printer that prints all this money, that gives it to them, to then weaponize it against us. We don't need to pass laws to prohibit people doing stuff with their money. We need to pass a law, or not even pass a law, but just take away the ability to print this money and give it to everybody.